Drake has $100 and no idea what to actually do with it. Every finance video he's watched talks about seven-figure portfolios and dividend income. Nothing about the first, smallest step. So this one's about exactly that. What literally happens the moment $100 turns into an investment, mechanically. Today, no million-dollar talk this time, just the actual first move. And why it matters more than people think. Quick one first. If the actual beginner steps are useful, not just the big number milestones, hit subscribe, new video every week. Before this $100 goes anywhere near the market, there's a real sequencing rule worth following. Figure out your actual finances first. Pay off high-interest debt like credit cards. And build a basic rainy day cash reserve, in that order, before investing anything long-term. This isn't arbitrary caution. It's because large company stocks, as a group, have lost money on average about 1 out of every 3 years. Money that might be needed soon shouldn't be sitting somewhere that can lose value the exact week it's needed. If Drake doesn't have that rainy day cushion yet, the honest answer is that $100 belongs in a high-yield savings account earning 4 to 5%, not in the stock market. Not because investing is bad, but because the sequencing genuinely matters more than the specific dollar amount involved. Opening the account itself is also worth walking through plainly, since it's often the actual barrier that stops people from starting at all. It typically takes identity verification, a linked bank account to fund the deposit, and a short questionnaire about income and investing goals, usually approved within the same day, with no minimum deposit at most major brokers, meaning the $100 itself is often the only real requirement. Assuming the foundation is already in place, here's the first mechanical fact that makes $100 usable at all: fractional shares. Most brokers now let an investor buy a portion of a single share rather than needing the full share price. So, $100 can buy a small slice of an expensive stock or fund instead of sitting idle, waiting to afford a whole share. Practically, this means opening a brokerage account, typing in a dollar amount rather than a number of shares, and the platform handles the math, buying however much of a share that $100 actually covers, down to fractions of a cent in some cases. It's worth briefly distinguishing index mutual funds from ETFs, since both get recommended for the same purpose. A traditional index mutual fund typically prices and trades once a day after markets close, and some carry a minimum initial investment above $100 at certain providers. An ETF trades throughout the day like a stock, generally has no minimum beyond the cost of one fractional share, and is usually the more accessible starting point for exactly this reason. For a first $100, index funds and ETFs are the most commonly recommended destination, because a single purchase buys instant diversification across an entire market index rather than betting on one company. An ETF tracking the S&P 500, for example, buys a small stake in hundreds of companies at once, and ETFs trade like stocks, meaning the minimum investment is just the cost of one share, or a fraction of one, with the same $100 fractional share mechanic from a moment ago. Fees matter even on $100, and matter more the longer the money stays invested. Index funds typically charge expense ratios of just 0.03 to 0.20% a year, while actively managed funds often charge 0.5 to 1.5%, a gap that compounds into a meaningfully larger drag over 20 or 30 years. Named examples that fit this profile include the Speeder S&P 500 ETF, Vanguard Total Market ETF, and Fidelity Zero funds, which carry no expense ratio at all. 2 mechanical details worth knowing at the moment of the actual purchase: order types and settlement. A market order buys immediately at whatever the current price happens to be. A limit order only executes if the price reaches a specific level the investor sets, which matters more for individual stocks than for broad index funds where the price barely moves purchase to purchase. Once the order executes, the trade typically settles within 1 business day under current U.S. market rules, meaning the shares, or fractional shares, show up in the account almost immediately, even though the underlying paperwork takes a little longer to finalize. For anyone who'd rather not pick individual funds at all, robo-advisors are a real, commonly used option. automated platforms that build and rebalance a diversified portfolio based on a short questionnaire about goals and risk tolerance, typically for a small annual fee on top of the underlying fund costs. This trades a bit of control for simplicity, a reasonable trade for a true beginner who mainly wants the $100 invested correctly without researching individual funds first. Beyond a single S&P 500 tracking fund, two other structures come up constantly for beginners. A three-fund portfolio combines U.S. stocks, international stocks, and bonds in set proportions for broader diversification across geographies and asset classes. A target date fund does something similar automatically, gradually shifting from more stocks to more bonds as a chosen retirement year approaches, rebalancing itself without any manual adjustment. A genuinely reasonable single-fund option for a first $100 that never needs to be touched or rebalanced by hand. How much of that $100 goes into stocks versus bonds depends on time horizon and risk tolerance. Someone 30-plus years from needing the money can generally handle more stock market volatility, since there's ample time to recover from a downturn. Someone closer to needing it usually shifts toward more bonds and cash, which carry lower returns but far less short-term swing. The real value of this first $100 isn't the $100 itself. It's what happens if it repeats. Dollar cost averaging means investing a fixed amount at regular intervals regardless of price, which reduces the risk of accidentally investing everything right before a downturn and tends to be emotionally easier for a new investor than a single large purchase made all at once. This is also exactly how most people already invest inside a 401k, even if they've never thought of it that way. A fixed amount. Every paycheck, regardless of what the market did that day. Setting up the same kind of recurring transfer for this taxable $100 a month plan is simply applying the identical logic outside of a retirement account. There are a few other ways $100 can enter the market worth knowing about, even if they're less commonly used than a standard brokerage account. Some companies offer direct stock plans, letting an investor buy shares straight from the company without a broker, saving on commissions, though the plan may charge its own fees, restrict purchases to specific days at an average price rather than a chosen moment, and sometimes limit participation to employees or existing shareholders. A dividend reinvestment plan, or DRIP, works similarly, automatically using any dividend payments from a stock already owned to buy more shares of that same stock, which requires signing an agreement with the company or broker and may carry its own small fee, but adds a second, quieter layer of compounding on top of the original $100. One account type worth naming specifically for a first $100, a Roth IRA. Contributions go in after tax, but growth and qualified withdrawals in retirement are entirely tax-free. A genuinely strong fit for someone early in their career sitting in a lower tax bracket now than they expect to be in decades later, since the tax is effectively paid at today's lower rate instead of a potentially higher future one. It's worth separating two different kinds of risk here too. Market risk, the investment itself losing value, is not protected against by anything. That's the nature of investing. But the brokerage account itself, separate from the investments inside it, is typically protected by SIP insurance up to $500,000 if the brokerage firm itself fails. Similar in spirit to FDIC insurance on a bank account, though it does not protect against a stock or fund simply losing value. The broker itself matters too. A discount broker charges lower commissions but expects the investor to research and choose investments independently, the more common and more cost-effective choice for a $100 starting point. A full-service broker charges noticeably higher fees in exchange for personalized advice based on that firm's own research, a cost structure that's harder to justify on a small initial balance where fees would eat a disproportionate share of the investment. This is precisely why fee awareness matters more, not less, at small account sizes. A $5 flat fee is a rounding error on a $10,000 purchase, but it's 5% of a $100 one. So confirming a broker charges no commission on ETF or stock purchases is worth checking before the very first deposit. One more tax mechanic worth knowing before selling anything, even from a $100 position: how long an investment is held changes its tax rate. Selling within 1 year of purchase counts as a short-term gain, taxed at the same rate as ordinary income. holding for more than 1 year before selling qualifies for the lower long-term capital gains rates instead. This is one more reason the buy and hold, dollar cost averaging approach from earlier tends to work better than frequent buying and selling. Even setting aside the behavioral benefits, one category worth actively avoiding with the first $100, penny stocks, very low-priced shares in small, often unproven companies with little or no earnings. These stocks don't pay dividends, are considered highly speculative, and carry a much higher risk of a total loss compared to established, diversified options. The appeal is obvious. A stock priced at a few cents feels like it can buy more shares for the same $100, but share price alone says nothing about a company's actual value or survival odds. And a company trading at a few cents a share is frequently a company the broader market has already judged to be in serious trouble. The contrast is worth naming directly. Blue-chip stocks are shares in large, well-established companies with a track record of growth and often a dividend, while penny stocks are essentially a bet on an unproven business surviving at all. For a first $100, the diversified index fund approach from earlier avoids this risk entirely by spreading that $100 across hundreds of companies instead of concentrating it in one speculative bet. A quiet, common mistake worth naming directly: checking the account too often. A $100 position moving by $1 or $2 on any given day is completely normal noise. Not a signal to act on, but checking daily or hourly makes small, meaningless fluctuations feel urgent. And that's exactly the pressure that leads new investors to sell during an ordinary dip instead of simply leaving the recurring plan alone. On its own, $100 invested once doesn't transform anyone's finances. And that's not really the point. The actual value is behavioral. Opening the account, learning the mechanics, and proving to yourself that the process works removes the intimidation that keeps a lot of people from ever starting. A recurring $100 a month, by contrast, invested consistently and left alone, is the exact mechanism behind every larger portfolio described elsewhere on this channel. The same fractional share index fund. Dollar cost averaging combination, just repeated for years instead of done once. It's also worth sequencing this correctly against retirement accounts. If there's an employer 401k match available, capturing that match first is generally a higher priority than this taxable $100 a month plan, since it's an immediate guaranteed return before any market risk is even involved. An IRA, capped at $7,000 a year for 2025, is usually the next priority after that. With a standard taxable brokerage account, where this first $100 most likely lives, coming after both, though nothing about that ordering means the taxable account has to wait for the other two to be maxed out entirely before starting, the $100 can begin today alongside whatever else is already in motion. One last practical note. This $100 a month figure isn't meant to stay $100 forever. As income grows, increasing the recurring contribution, ideally before that extra money gets absorbed into everyday spending, is how this same simple mechanism scales into the larger portfolios discussed elsewhere on this channel. The process doesn't get more complicated with a bigger number. The number just gets bigger. Investing $100 for the first time is mostly mechanical, not mysterious. Confirm the rainy day fund and high-interest debt are handled first. Use fractional shares to buy into a low-cost index fund or ETF. Avoid penny stocks entirely. Understand the difference between market risk and brokerage risk. And set up a recurring monthly amount rather than treating it as a one-time event. The $100 itself isn't the milestone. Proving the process works, so it can repeat for years, is everything in this video: opening the account, buying the fractional share, setting up the recurring transfer, is available to essentially anyone with a bank account and a phone. Today, not someday. Whatever the exact balance happens to read this very afternoon. This video is for educational purposes only and is not personalized financial advice. If this made investing finally feel like something you could actually start today, subscribe. New video every week. Next up, why one bad month is all it takes to go from fine to broke at every income level.